This is our Forex blog for September 20th, 2013, and these are our currency indexes, which let you see what each individual currency is doing. For instance, what is the dollar doing, or the euro? In the past, we've used currency meters to measure the strength or weakness, but now you can actually see, is the euro going up or down? Is it able to get above a certain resistance area? In other words, be stronger than it was 5, 6, 7 hours ago, or the previous day's high or low. For instance, the pound. This is the previous day's low in the pound, and it was above it, acted as resist or support. Once broken down, it fell, broke back into the range, fell again, acted as resistance, These are things that you can't see on our old currency indexes, and you really can't get elsewhere. I invented these myself and used it for many months before releasing it in the software. You can also see trend lines, and when the market's staying underneath those trend lines, you want to go short that currency. Our perfect oscillator I absolutely love, because on the individual currency basis, this works on the individual currency indexes and the regular trading pairs. When it hits the plus 80 level, it tends to reverse. Look at that right here, especially when the trend's down. You know, this one just made a swing low, retrace back up. It looks like about a 62% fib level. And also the upper Bollinger Bands on this indicator are oftentimes reversals, as you can see here, here, and here. And if you notice on the downside, minus 80 level, is that a support level? The previous week's most actively traded price. And again right here. And you got to bounce off of those. So a lot of times you can just simply wait for plus 80 levels to get short and minus 80 levels to buy that individual currency. So when you see one currency that's weak and another one that's strong, obviously you want to sell the weak one versus the strong, or if the strong one's on top, you want to buy that one versus the other. So let's take a look at the yen. Now, keep in mind the daily, weekly, monthly trend on this is down, but it broke, a trend line right here around 1130, and it wasn't able really to go lower. It's a nice little wedge pattern breakout at 1130. Which one's weak? Well, you can see the pound has been trending down of all the other three currencies right there, and at 1130, this is one that's likely soon to pull back. It's got the previous day's low right there. So this is one example of a currency that you can look to sell. You want to sell the pound yen. Or at least you're looking at the chart to sell it at 1130. And you can see pretty much exactly what happened. The yen broke out to the upside, and you really probably would want to wait till that little trend line got broken. It fell 20 pips or 10 pips here, a little bit of a pullback, you go short again. But nonetheless, from 1130 onward, you can see it fell from 30 all the way down to 97. It's a relatively dead time of the day, especially on a Friday. So let's try to find some other examples with some currencies that are really moving. You can see the Swiss went from underneath above its hourly moving average and held support there the whole day. And the Australian is just absolutely weak. It broke down from above the hourly moving average to underneath it. It wasn't able to make a higher high in the last move up. And so at 330 right here, the Australian is likely to go down. You can see the New Zealand strong. The daily, weekly, monthly trends up. It broke from below to above its hourly moving average, and it really wasn't underneath there that much. So selling the Australian New Zealand is a very high probability trade. Weak one versus a strong one. It's really that simple. You're looking at the chart, you really would probably go short right here with your stop above the swing high. It went a little bit your way, then reversed, didn't stop you out, and then it trended down. So you would have made probably 20 pips on that. If you sold here, you made a little bit. If you sold here, you also made 20 or so pips. But that's basically how you use it on a perfect day. Now let me show you our FX trade signals. This is pretty much what most people want. This shows you basically buy and sell signals. And not knowing anything else, you basically, when you get a sell signal, you sell. And you put your stop right above that bar's high. So, for instance, right here, short, stops above here, kind of goes your way a little bit. You can see the previous swing was down. You might get out of that trade right there with 8 or 9 pips. Short right here, goes down. Anytime you get a buy signal, if it goes 1 pip above that bar's high, you get long. And you can see you made about 8 pips there. Your stop's underneath here. Kind of went your way, pulled back, came back up again. You'd be out of that trade with a small win. Short, you lost here, but every other trade was a win. Short here, you'd still be in that trade. Big win. Short here, your stop's above the high. Typically, once it goes a bar or two my way, I move my stop down. That would have been a small loser. Short right here. Typically I'd be looking to get out of this, but there's another sell signal here, so I'm just going to wait. Stops above, a few pips above the bar's high, and then you get out right here. Remember, you stay short pretty much until you can use a trailing stop, displaced moving average. But there's so many signals that frequently when there's a sell, there's going to be a buy or counter trend signals are going to pop in, and you can get out of your trend trade. Let's say you're short around 2022. You're out of this at around 05. You made 15 to 18 pips on that trade. You went long. And this is a good example when you're long and you get a sell signal. Typically, I'll wait a pip or two underneath there to get out, and it didn't get out at this point. You have another sell signal here, so you're out of that trade right here. And unfortunately, that next trade didn't work. But you made money on your long, and anytime it starts to go your way, another bar, you move your stop down, you're in here with a small loss, and you would have lost on this. You made money on this one, and then this is obviously after 12 o'clock on Friday. You don't really want to trade too much, but you can see the majority of the trades worked. Let me circle the ones that would have resulted in some profit today. And this is also excellent for scalpers. So you can see of all those trades, every one except 1, 2, and 3 resulted in the possibility of some profit. And most of the trades that failed, at least one out of those 3 give you the opportunity, because it went up and then down again, didn't really break those lows, went 1 pip underneath there, give you the opportunity to get out with a very, very tiny loss, not your full loss if you're watching this. Now keep in mind also the euro dollar. If you look at the actual index, I'm going to scroll this back. Oops, this isn't the, let's take a look here. They're both pretty much underneath their hourly moving average. And then the dollar breaks out to the upside. When both currencies are above their hourly, you're going to have pretty choppy trading. If you focus on a currency that's maybe above the hourly versus another one that's below the hourly, you're going to do a lot better taking trend trades. In other words, you'd be buying the euro pound. Here's a good example of this. And I don't really trade the euro pound that much, but strong euro, weak pound, you're focusing on buy signals, and you can see, it went up about 20-25 pips. This is really how it's meant to be traded. You use a currency index to focus on buying a strong currency versus a weak. In other words, the pound's trend is down, the euro's trend, which is on the top of this currency, is up. And when you get one currency that's strong and the other one's weak, the buy signals are very high probability. Now again, this one doesn't move that much. Using a 5 pips per bar chart, there's probably going to be fewer signals. You could, on currencies that don't move that much, maybe try 3 pips per bar. Again, I don't spend that much time testing the signals on other currencies, but you can certainly do that to possibly find some other trades. You can see 2 buy signals right here that worked. This one here at least went up 2 bars. This one here continued up. This one continued up. Anytime a currency at least moves 1 bar my way, I consider it kind of a success, because at least you have the chance to get out of the trade near break even. And as you can see, by lowering the number of pips per bar, you can find more trades. Let's look at one more example, because everyone's asking how to use these to trade with. Obviously the euro's up and the pound's down. The yen is just chopping around. The dollar's been strong all day. You can see the Australian is weak, and the CAD is weak until about 7. So here you have the Australian dollar. Remember, the dollar, or the Australian's on top, so the Australian's weak, and the one on the bottom is strong. And so when one currency that's on top, the Australian, is weak, and the other one is strong, you're going to get very likely to be a downtrend. So basically, if you focus on the sells, you had a loss here, small win, decent win, small loss, decent win, small loss, loss. Yeah, this would be pretty much break even, and a big win. But you can see this, the wins are substantially bigger. Let's just focus on, how big these wins or losses are. This one's a tiny little loss, but that's about the size of it. Losses are very, very tiny. Short here, out here, small loss. Short here. Remember, this one went your way a little bit, so your loss is almost nothing on there. So you have tiny loss, tiny loss, tiny loss, big win, medium-sized win, medium-sized win, probably 15, 20 pip win. And that's it in a nutshell. I mean, if you use the currency index to spot which currencies to buy and sell, and then you just leave, a slew of range charts running, you can put up multiple different range or layers and show and hide things at will. You could have currencies you don't trade that much on, layers after 10, and you can just show something by pushing it down or turn it off, and use the currency indexes to focus on the best ones, and then wait for a signal. And with the charts, you actually get audio alerts that tell you, Australian dollar sell signal. You look at the indexes, the Australian's weak, the dollar's strong. You take a look at the chart. It's always better when the market retraces a little bit from the lows. If the Australian dollar is right near the lows, 5 or 10 pips away from the low, it's a much riskier trade than if it's pulled up, 15 to 25 pips from the low. Then it's likely to continue its trend. The riskiest trades are buying the highs and selling the lows. As long as you kind of wait for a decent pullback, you're going to do better. Keep in mind that these signals were made and invented for the euro dollar. So, eventually when I perfected them on the euro dollar, I will, try to put in code that maybe is a little bit stricter in the non-euro dollar, pound dollar, euro yen, and pound yen charts.